Hi everyone and welcome to Inderes TV. Today we have a special guest, Eeemeli.
Hello.
Hi. And we're going to talk about the ROIC as a term. And this is really hard to do, but we're going to give it a try. ROIC, why is it so important? We have written it out and we're going to dig deep into it.
When thinking about investing, we are investing into stocks. There is always a business behind the stock. You have to always thinking about how that business will perform in future, because the business performance is crucial part of the good returns of investors. And one way to figure out how effectively company is using its capital or management is allocating capital in the business. One way is to use return on invested capital ratio to figure out that is it good company or figure out would be in the future good company.
So this is kind of more, we were discussing this before we put the camera on, this is kind of more of a business way of thinking about an investment, more like just financially as an investor.
Yes. Because obviously when you're doing a business, you need, almost every company needs capital from equity investors and bondholders as well. And thinking about how effectively that company is using that capital, the ROIC is the one way to measure that how profitably that company uses this capital.
And this is, we have written it out here, and it actually cooks down to two things. Mm-hmm. And that's what you said, a measure of earnings capacity for the business and the ability to allocate capital. Mm. And if you take a look at the formula.
Yes.
For ROIC.
Yes. You can split it into two parts. First part is the net operating profit after taxes margin, and it reflects that company's operational efficiency. Mm-hmm. And second part is the revenue divided by invested capital, and that reflects how capital efficient that business is.
So this is the part for investors and bondholders.
Yeah, this ratio takes into account both equity investors' capital and the bondholders' capital, what is invested in the business.
Yes. When you look at this one,
this is operational profit margin, how much profit that business itself is generating after taxes.
Yeah, and this is kind of more from a shareholder's perspective than this part, just looking at the whole package.
This EBIT margin is measure for how much that business is generating, both of them, for equity investors and the bondholders. And if we want to think about profit measure for equity investor itself, it is net income margin for better for that use.
And if we split this one in two parts, NOPAT, what does this stand for?
It is net operating profit after taxes, and put simple, it is EBIT margin minus tax rate.
Yeah. And why we've written down the other ones? If we start by ROE, why is this one not as interesting as this one?
ROIC is the better measure because, in my opinion, it's not subordinate to financial decisions made or to be made, but return on equity, it's more leverage ratio, and it is subordinate to financial decisions made and to be made. And you have to separate investing decisions from the financing decisions when thinking about investing opportunities in the business.
And here again, this from a business operating point of view.
Yes.
So if you're just staring your eyes blind on this measurement, ROE, it's kind of more thinking of it from an investor's point of view. But when you use this whole picture, you can put the entrepreneurial hat on and think, will this business survive over a long period of time?
Yes.
So decision making comes down to, is this a good operating model or is this a good way of financing?
Yes, return on equity is more equity investor from equity investor perspective, and return on invested capital. It doesn't matter how you are financed your business. The point is that how effectively that company is using that capital. It doesn't matter is it from equity investor or bondholders.
Yeah, true. How do ROE differ from ROIC?
It does not take into account taxes, and obviously company which is generating some profits, it must pay taxes in the long term. And but return on investment is enough good proxy for the return on invested capital. And because if you think about a company which operates in Finland, you know approximately what is the tax rate for that company is, and you can just take a return on investment ratio and deduct the taxes from that ratio, and you can get enough good proxy for thinking about return on invested capital.
Yeah, so you would say return on investments is a fair enough proxy, but you would like to dig deeper.
Yes, correct.
Yeah.
Yes.
And then let's talk a bit about margins, because I myself like to look at margins, and you said specifically that high margins does not save you. It's a good measure to start with, but what you really need to look at is the whole picture. So could you please elaborate that, and how would you connect it to the return on invested capital?
Yes, because every business needs a capital, and in order to grow business, you need to invest before you get those returns, and you always have to think about not only the earnings growth or operating profit growth, but also how much capital that earnings growth tied, and obviously every capital have some kind of cost, and cost of capital is not a crucial part of thinking about when we think about thinking about business value creation. If you get invest in some project and get X amount of profits, you have to compare those profits to the cost of capital, what that capital costs for your business.
So it's not enough to generate growth, you have to know what that growth costs you over time as well, and it has to be efficient. And this is where the whole formula comes in.
Yes, exactly.
What would you say, is it easier to have better measures of return on invested capital in certain industries, or is it not industry specific?
Yes, actually it is quite many times. For example, utilities or airlines industry, they are generating quite low return on invested capital because they are very capital heavy industries. You have to invest much capital in the operations and especially utilities. Your end product is very homogeneous and you have quite small chance to differentiate your end product, and that's why the return on invested capital ratios are quite low. But on the other hand, for example, software sector business models are very asset light, but entry barriers to the markets are, in my opinion, quite low. But creating sustainable competitive advantage is very hard. And therefore, yes, return on invested capital ratios are high in that industry, but in my opinion, they can't be so sustainable because that these characteristics of that industry.
So now you're going into the moat, kind of. It's because if your need for capital is big, it's important that you have a moat and an end product that can differentiate itself from the others.
Yes.
Yeah. But if you think about where it could be, what would be the perfect business from a ROIC point of view?
For example, the article what I written a couple of weeks ago.
Link down below.
Yes, there is a Michael Mambussin papers in the article, and in the one paper I don't remember that name, but Mambussin researched industries where the return on invested capital are high or low, and especially in the household products industry there is a high return on invested capital, and in generally consumer staple companies are generating quite high return on invested capital. And in my understanding it reflects that there is a quite strong brands in those companies, and they have some kind of pricing power in the business, and they get high margins, and by high margins they generate high return on invested capital.
Yeah, but that's not equal to one. But the high margin helps.
Yes.
But it's not
yes.
Said that a high margin means a good return on invested capital. But you're kind of putting in here a strong brand, high margins, low cost of capital, and a moat. Because even though you would have all those other things in place, if it's easy to entry, then you're not kind of building the critical success factor that you will need.
Yes, exactly.
Thank you so much for all these comments. We hope you got something out of it. We'll be back.